We're just flickering in and out of the red and the green, but the one decisive trend is that fall that you're seeing in the IT names. And that, of course, is with Anthropic really sort of spooking the global IT services plays and most SaaS players globally as well, not just here in India. It seems like it's questioning whether they're going to be viable in the future or how much are they going to be viable or not. Let's discuss Sandip Agarwal from Sowilo Investment Managers, this with him and try and understand how is it going to play out for the Indian IT services plays. Sandip, hi, great to have you on the show. Sandip, analyze the Anthropic's AI tools for us. What do they do and why is it that they pose a challenge for Indian IT services?
Hi, good morning, and thanks for having me on the show. So yes, there has been a sharp reaction on the product, which has been repackaged. I think it was already there, and now it has come into a more user-friendly version. And because of that, a lot of SaaS companies and the ERP companies, they have reacted quite sharply. And I think that reaction should have happened long back. But generally, we believe when we see the impact and we see the things. So let me, separate both Indian IT companies separately from the SaaS and the ERP players, the reaction where you have seen yesterday night. I don't think that we get impacted the same way they get impacted, primarily because, we are second derivative to them in terms of exposure. We are more in maintenance and, implementation and a lot of things, which is a second derivative and not the first derivative, the way the SaaS. And so I think that the reaction which we have seen in Indian stock market today is commensurate with that. We are down 5-6% and they were down 10-11%. So I think it is a very logical kind of move. I will not call it a illogical kind of move or any reaction which is not calculated. So that is what my see this all these things which are coming, all these are add-on tools which these companies are now coming out because they have the big tech platforms, they have the customer reach, and they will definitely keep on adding these tools for improving efficiency. And we have highlighted for last 12 to 14 months, every time we have come on your show that, this is the first disruption where efforts are going down by 20-30%. And so you cannot, compare them to any other past disruption where, efforts never went down, only the technology changed. So basically you have to reskill your efforts towards the new technology, 2-3 quarters of disruption, and then growth comes back very sharply. This is a totally different disruption, AI itself, because it brings in 20-30% cut in efforts and efficiency. So I think from that perspective, all the software players, SaaS players, everyone will see much lower growth for a longer period of time. And Indian IT cannot be immune to that. We have very good advantage that, we do work, our projects are over 5 to 6 years minimum today also on an average. So it gives us 5-6 years time to, recoup these losses. So every year you will only have a negative impact 2-3%, unlike the SaaS and direct players who will have sharp impact on day one. So I think we are much immune to them comparatively, and we will have a better option here compared to them. So I would say that for us it is a low growth for long term, but nothing immediately impacts us. So eventually our multiples will be probably 15-20% premium to the utility companies. I believe the PEG ratios will become more and more relevant in the space for Indian IT rather than absolute PE ratios. Long answer to your question, sorry.
No, much needed as well, because it's almost seemed like this is a little bit of a panic situation. But looking at the screen right now, it seems that there could be more to it. So net, Sandeep, would you say that this kind of a knee-jerk reaction is irrational at this juncture? Or would you say that there could be a deeper correction that one could, see in the IT pack?
I would say that, we will see more, we will see a slow death of the multiple. The multiples today also, while people are publishing 10-year average PE and all that, I think that is grossly wrong because growth rates have changed. So I think the PEG ratios will have to be more measured and calculated. Large cap Indian IT, if they grow more than, single digit in next 3 to 5 years, I will be positively surprised. Unless there is a big reset in 1 year and because of that base effect, they do better in 1 year. But otherwise, on a CAGR basis, 6-7% growth for the large cap IT company is a very optimistic number. Now, what kind of multiple you want to assign them for that? I think, ideally they should be 10x, but maybe because they are bringing in foreign exchange, the distribution is good, the dividend yields are good, managements are superb, and we are indispensable for most of the world in terms of software service. So you can give, 2 PEG ratio, maybe 12 times, 13 times. But the obnoxiously high multiple, all of them are trading. is not discounting the reality. That is the way I put. Similarly, for mid cap, maybe 15, 16 times forward earnings, and small cap also 15, 16 times is where I'm comfortable with. Nothing is available at those prices right now. So I think slowly the time correction will eat away the multiple. That is what my sense is.
Sandeep, how real is the risk of AI? And I know you've given us some color on that. But firstly, very good morning. How real is the risk from AI on some of these companies? So, of course, you're suggesting that single-digit growth could well continue to be likely. But is the AI risk very, very real? Is this also something that plays on your mind, or not at all?
No, the AI risk is real, but we remember we are the software factory of the world, and we execute the projects, implementation, migration, everything at a breakneck speed and in most efficient way. So obviously we will be the least impacted. Let me put it that way. We will not be impacted like the front running, SaaS and ERP companies, which will happen. You will see a lot of damage there going forward. I will be surprised if they don't correct up by a meaningful number going forward. We will be least impacted. Only thing is that we cannot say that we will not be impacted, because 20-30% effort reduction even in a 5-year 6-year time horizon for us is like 3-4% effort reduction every year. So we have to grow. We have to just not only cover up that 3-4% decline, but we also have to grow. So if when I say 6-7% CAGR, it means that they have to grow at 10%, which is very, very tough ask. So that is the reason, as I said, the peg ratios are very high, and stocks will either see time correction or they will see price correction. But our corrections will be much, much, much lesser than what is going to happen in next few quarters in the developed markets. I am reasonably confident our IT services will massively outperform those companies, but at the same time, they will not make money in absolute terms.
So, Sandeep, for the benefit of our viewers, at what multiples would you be comfortable buying the Indian IT stocks?
So large cap, I will be not more than 10-11 times in terms of 1 year forward earnings. Mid cap maybe 14-15 times 1 year forward earnings, because that is where I get things at 2.5 times peg ratio, and then I have to make at least 50% in 2 years. So then I need to get an exit peg ratio also. So from that perspective, I think that is the comfort zone. Nothing is available right now there. We are patiently waiting for last now 18 months. We have sold everything before that. Now we are patiently waiting for our turn. Probably we will get that opportunity, or time correction will allow the earnings to go up materially. So either of those things will happen. If they come to that level, we will invest. Otherwise, there are so many other sectors in the country to invest.
Absolutely, Sandeep. Sandeep, now we've got pretty much all IT companies which have come out with numbers. Talk to us about two things. One is, what were the highlights, or what were things that really stood out for you? Maybe 2 or 3 things. And second is with regard to demand. When does discretionary demand likely pick up? Any indication that you've got from any of these companies?
No, so I am positively surprised with the numbers in this quarter, and let me tell you that it strengthens my belief that we are the most efficient country when it comes to software services. All the results you see, there is a flawless execution in such tough environment. They have been able to manage their margins. They have been able to grow something. So fabulous job. All the management. I will not call out anyone. Everyone has done a phenomenal job. And it gives me a lot more conviction that this is one industry where we are number one in the world, and probably will continue to be so. At the same time, I am still little worried, because on the other side, because what is happening is that most of the people who are tracking AI, the analyst community, and many other people, they are still highlighting that it will eat away the entry level job. Where I have a very big contrarian view. I don't think that entry level employment is going to get impacted, because entry level salaries are so low, and slowly this all things will flow down to editorial job in terms of coding, editing the codes, and also that entry level I don't see big threat. Where I see big threat is the mid level, because mid level salaries are high, and you can't afford to get entry level work done from the middle level employees. So from that perspective also, I would say that Indian IT companies have done a phenomenal job. In last 6-7 quarters, they have smoothened out the exits. They have not recruited aggressively, and they have tried to rationalize the pyramid. But I still see there is some bit of fat in between, which will have to slowly go away. But the very positive thing is that a lot of these tech platforms are coming in India, and they need this mid-level people who are there in the IT services for long term to set up their processes, system, database, and everything. So you are not seeing the impact on the economy. You're not seeing it's to be so negative, because a lot of this talent is getting absorbed by the new age tech platforms. But otherwise, the mid layer in the IT services, still I think there is a lot of people who will leave or who will reskill. But we have a very good absorption from the tech platforms, and I think that is what is balancing the thing. So I am not so negative on the employment environment, or I am not so negative on any of those aspects. But I would only say that stocks have to undergo more time correction.
Okay, fair point. Sandip, always great to have you on the show. Thanks for that insight. Okay, on that note, let's take a very quick break.